I'm Taylor Riggs in San Francisco. This is Bloomberg Technology. Titans of tech. Oracle CEO takes leave. Mark Hurd announces he will take a leave of absence for health reasons. Shares slip in post-market trading as revenue also comes up short. We'll have details. Plus, the Cisco grid. We'll talk potential supply chain disruption amid U.S.-China trade tensions with John Chambers, former CEO of Cisco. And linking up, we get an exclusive check-in with LinkedIn CEO Jeff Weiner. His thoughts on the company 3 years after Microsoft acquired the job listing site. But first, to our top story. A late developing shakeup at the top of Oracle. CEO Mark Hurd is stepping down for health reasons. The company did not specify what issues he is facing, but executive chairman Larry Ellison released a statement saying, quote, Oracle has an extremely capable CEO in Safra Catz and an extraordinarily deep team of executives, many with long tenure at Oracle. Safra and I will cover Mark's responsibilities during his absence with support from the rest of our strong management team. Joining me to discuss, Bloomberg Intelligence Senior Analyst Anurag Rana in New York, and also with us, our Global Executive Editor, Tom Giles. Tom, thank you for crashing on this. How surprising was this announcement?
As far as his leave, so there have been signs over the last year that he may not be unwell. What was not expected was the announcement to come today. So, and because they hadn't announced it up until now, there was a question mark about whether they would and whether he was getting well or not. So it took us a little bit by surprise, the timing in particular.
Anurag, I want to bring you in here. You heard it from Larry's mouth. He said that he and Safra will take over. Does any of this change the future direction of the company?
No, it doesn't change the future direction of the company. Oracle is a very stable business from, given the large on-premise database business that they have and a very large applications business. The key risk for Oracle, or the key story for Oracle, remains how soon can they get their database customers onto the cloud. That story still remains the same. I don't see any changes because of this shift.
Tom, Mark Hurd really was known as working on shifting that composition from hardware to software. He touted getting to 50% software. How did he do?
Yeah, well, so it's been a mixed record for Oracle over the last several years. Now, their stock price, I should note, has been really over 20% gain this year because a lot of investors are looking at that staff, that deep bench. They're looking at the shift, and they're starting to see signs that it's taking root. It hasn't been even. There have been quarters where people have really doubted. Today's numbers, again, which we'll talk about in a minute, looking a little light. So it hasn't been super even. However, what you are seeing is when customers do shift to the cloud, that is where the growth is really coming from. The legacy database business, traditional software, has not been growing as needed. And has the shift been happening as quickly as people wanted? Sometimes the answer has been no. But again, when you look at that stock price, you're seeing an investor base giving them the benefit of the doubt.
Anurag, talk to me about the earnings. Top line, a little bit of a miss. Margins generally look healthy. What was your takeaway?
Generally an inline quarter with almost everything. There was slight slowdown in the application business, but at the same time we saw margins expanding, we saw buybacks. Overall, I wasn't that surprised with any of the numbers so far. The key issue remains how soon some of the new database products adoption goes, and that we'll see from the call as to how that's going along.
Tom, what does a $15 billion buyback tell you? They have nowhere else to invest, or they actually think their shares are undervalued?
I think it's a little bit of both. Are there acquisitions that you can make? Are there large size acquisitions that you can make? Oracle over the years has been a big acquirer, and they have made some big acquisitions. It seems to me that there's not a lot in the pipeline right now that they want to take aim at, but they have a lot of cash, so I wouldn't rule it out. $15 billion shows a vote of confidence that they have in their stock. When you're announcing that a CEO is taking a leave of absence. Again, you want there to be some vote of confidence on the part of the management, and as Larry said in his statement, they have a lot of confidence in their bench. Safra Catz, very capable, very, very well regarded, and Larry, even though he handed over the reins, has never really strayed that far from having a hand in how the company is managed.
Anurag, did the cloud services revenue meet your expectations?
There was, as I said, there was slight slowdown in the applications area, but overall it's lumpy because unlike an Adobe or an Office 365, these large enterprise deals for somebody like an Oracle, could take time. As I said, nothing surprising from our side, generally inline quarter for us.
Tom, generally speaking, how is Oracle set up among China and tariffs? It's something we talk so often about within the tech sector. What's your broad take?
Right now, I mean, a lot of companies in the tech sector are going to be affected by the tariffs. A lot of it has to do in areas such as hardware. Oracle has not been one of the companies that we've looked at and said, this is going to be a huge hit for them. We talk about Apple a lot. We talk about some of the other companies, some of the chip makers, for example. Oracle, less so. That hasn't been a big area of overhang. I'd be curious to hear what Anurag says about that. But really, the tariff issue is one that we think is going to hit a lot of the other big tech players aside from Oracle.
So, Anurag, was the revenue miss not related to tariffs?
No, I don't think so. But as to Tom's comments, enterprise software spending has very little exposure to China, unlike consumer products. But what happens is when you have shocks like China or when you have macro shocks, people pull back spending, enterprise tech spending. You really don't need to upgrade if you don't have to, because you can go around another 6 months before getting that new server or upgrading to the new set of software. And that's where we have already started to see some kind of cracks in the software growth story with some of the companies such as Autodesk talking about some weaknesses in Europe right now that is leading to enterprises spending less on software.
So, Anurag, we know that all the glitz and the glam is in software. Get us back to basics. How's the hardware business doing?
Hardware business for, a lot of vendors has been weak, and that has been the story for a while because people have been delaying their hardware upgrade cycles just largely because whatever little money that they have, they want to spend it on the next digital transformation, which means you want to spend it on either advanced security products or you want to spend it on cloud products. So people take money from hardware and they're spending more on software.
Tom, key takeaway from the earnings call that you'll be listening to, all about the CEO?
A lot about the CEO. Why didn't they disclose it sooner than they did? There might be questions along those lines. Who will be in charge of what set of responsibilities that Mark was in charge of? How concerned are they about his health? How long will he be away? And certainly, cloud. That's something that it always comes back to. And as Anurag was pointing out, as people move more and more to the cloud, that's also something that affects spending on hardware, which has not been a real strength business for them.
Anurag, number one talking point from the call that you want to hear?
We want to see what what's the transition or what's the take rate for their new database product. That's a very important thing for us because that's what really dictates how soon people will adopt to the cloud. And any new applications business bookings numbers, those would be the two areas that we'd be looking at.
My thank you to Anurag Rana and Tom Giles. And coming up, we will get reaction on Mark Hurd's leave of absence from Oracle. Former Cisco CEO John Chambers joins us next. And if you like Bloomberg News, check us out on the radio. You can listen to us on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. All eyes are on Oracle today after the company announced that Mark Hurd will take a leave of absence for health reasons. The earnings call will potentially give us more information on those reasons. And with more on that, plus the continued trade tensions between the U.S. and China, I want to bring in JC2 Ventures CEO and founder and former Cisco CEO, that is John Chambers. JC2 Ventures focuses on helping startups build and scale across the globe. John, great to have you. First, sort of give me your take about this news that Mark Hurd will take a leave of absence. What is your reaction?
Well, my reaction first and most important is for, as Larry Ellison said, a speedy recovery for Mark. I think he's in my thoughts and prayers. And if you really think about the team of Larry Ellison, Safra Catz, Mark Hurd, they work more effectively than almost anybody envisioned that a threesome would work. But Larry and Safra have worked together for, I don't know, 25 years. And I know all three of them very, very well. Safra is world-class, off the charts. Larry has always been involved in the strategy, the vision, the engineering side of the house, and I think they'll navigate through this one. I don't think they'll have any major issues at all. They've got a deep company, a lot of capabilities, and as I said, Larry and Safra are world-class leaders that are very actively involved, and my thoughts are with Mark for a speedy recovery.
Yeah, John, talk to me more about your relationship with Mark Hurd during Cisco and then his time at Oracle. How was that relationship?
Well, the relationships with Oracle and HP have always been very strong for me. I have a lot of confidence in HP. They helped me when I first moved out to Silicon Valley understand the Valley when I only had 400 people at Cisco, and people got us confused with a food truck company. And Lou Platt there helped a great deal. Their new CEO, Antonio, is amazingly good, and I have a lot of confidence in the direction of HP, and Meg did a nice job on the turnaround. In terms of Safra and Larry, I've always been very, very close to them, both on political issues in terms of positioning tech for good in the world, and they're very, very strong leaders. I would always bet on Larry and Safra and Mark together, and I'd bet on Larry and Safra in the interim, and they've got a deep team. So as an investor, I think they'll navigate through this one very well.
John, another big story that we continue to monitor continues to be the U.S.-China trade fight and tariffs. We haven't quite seen it show up or impact the bottom line of companies. Where are you seeing the impact of tariffs the most?
Well, remember again that I'm not in any way associated with Cisco. That company, when I left, it was important their leadership run the company and that I wasn't looking over their shoulder in any way. And I've been in China for 30 years, understand the market extremely well. And I think one of your prior colleagues said it well. For enterprise business, I think the impact is going to be fairly small enterprise-type companies. If you're in service provider or government, that might be a little bit different. Supply chain people are going to have to work through. However, taking the step backwards, there needed to be a resolution in the trade unbalance between the U.S. and China, a $570 billion number versus $140 billion. And we have to treat American companies in China fairly like we treat Chinese companies here. And I think that needed to be resolved. And while all of us wish it would be a little bit smoother in the resolution, it was something that had to occur. We had to stop kicking the can down the highway and not dealing with the issues. If you want to look at one that is going well, and in my opinion, handling it right, the U.S.-India trade issues. If you watch what President Trump and Prime Minister Modi, both of them are heavily involved in that. Both of them are taking very much constructive roles on how do you get our countries working together. And as I've said several times on your all's show, I think the most important strategic relationship between any two countries in the world for the U.S. is the U.S. and India. I very much admire Prime Minister Modi. I will see him later this month in New York with other CEOs. So there's a model of one that I think is going in the right direction, and I'm cautiously optimistic you'll see that type of trade issue resolved effectively there.
John, I want to talk about the elasticity of the supply chains. Come into my terminal here at GTV Go. I will use Cisco as an example, knowing that you are no longer directly involved. And we take a look at the suppliers. And frankly, a lot of these big tech companies have big exposure to China. Talk to me about elasticity. Can we start to automatically move to India, like you said, to Vietnam? How quickly can you do that?
It takes time, and I think the time to move to India or Mexico or other sources or to balance your supply chain takes multiple years to do. You can't do it quickly. India is in the very early stages of Prime Minister Modi's digital manufacturing focus, and I think they're making very solid progress on it, but that takes time to really do. So for these companies, they have to do it very carefully. All of them focus on supply chain and understanding it, and it's in everybody's everybody's best interest that the supply chain work very effectively during both the good times and when there's a little bit of constructive give and take in terms of challenges.
John, how healthy is the IPO market right now?
I think it's very healthy. And this is a great question because when you ask that question, you're really asking 3 or 4 questions. The first is for jobs in the U.S., in terms of the future, large companies will cut dramatically their headcount due to automation, artificial intelligence, digitization, etc. So it's so important that our startup economy and IPO market go well because 75% of the headcount that companies add are after they become unicorns or after they do an IPO in the marketplace. So the pipeline looks good, but I'd like to see us double that over the next 3 to 5 years. I think there'll be some IPOs that will dramatically outperform the market. There'll be some that miss on that. And the only input that I would have to investors, but also the companies going public, I think it's so important as you do this to have a very clear path to profitability and a very clear path to cash flow positive. And for the 18 companies that I'm providing guidance to, and hopefully we'll bring a number of them public, even on your all show and talk about them, they'll have a very clear path to profitability and free cash flow. In fact, most of them will be profitable and free cash flow well before we take them public. So I think that's the one caveat I'd watch as an investor.
So, John, talk to me about that. I want to come back in my terminal here at GTV Go. 2 things you just said struck me. One, free cash flow positive and looking for profitability. One could argue Beyond Meat has a path to profitability and being free cash flow positive. They are trading right near around the average analyst price target of a 150. And second, your point on sort of alternative meats, if you will, or alternative food sources. Walk me through some of the startups that you like and why you're bullish on alternative food sources.
All right. So first of all, I think it's very important to have alternative food sources given the challenges that we have purely on agricultural production and meat production. You're already taking up the equivalent of all of Africa and the equivalent of all of Latin America just in geographic area that's needed to do this with tremendous damage to the environment in terms of the meat sources. So the ability to think about alternatives to meat are very important. I have to, in full disclosure, share with your viewership that I bet big time on a company in terms of crickets being one of the next forms of protein. The cleanest form, Spare Foods, Mohammed, the CEO there, is doing an amazing job. And I think people realize with Beyond Meat that you can not only produce very good products here that have equally as good quality protein, but you can do it with less damage to the environment, and they taste pretty good and very likely be better for your health. So I'm betting if Beyond Meat, I would bet on crickets as the next form of protein. And so I think
John,
ag tech is probably the least overhyped area.
Well, you can join me on set next time, and we will enjoy some crickets together. That was JC2 Ventures CEO and founder John Chambers. Thank you for joining me. And coming up, reworking WeWork, why the company is looking to make changes at the top, but will it be enough to save its IPO as investors worry? We'll discuss next. This is Bloomberg. And now we turn to a story we're continuing to follow. WeWork's suddenly troubled IPO. Bloomberg has learned that the office leasing company is considering major changes to its governance structure to address investor concerns. This, coupled with WeWork's lead banks worried about going ahead with the share sale that could value the company as low as $15 billion. Joining me to discuss in New York, Kevin McNeil, Director of Technology at Fitch Ratings, where WeWork's rating was downgraded to a B from a double B minus. So, Kevin, give me the biggest reason for the downgrade.
Well, essentially, since we rated them in April of 2018, the company raised subsequent capital and then pursued a more aggressive strategy. And it basically increased its cost structure quite substantially. It increased its headcount by over 12,000 people, and it's investing ahead of growth. And as a result, we now see that the point at which the company will become profitable is now pushed out several years from where we originally thought it would be.
And Kevin, going forward, what would be a further catalyst for another downgrade or your biggest downside risk?
Well, it's too early to tell, I think, at this point. When we made the rating change in August, it was predicated upon the company going forward with its capital raising plan. But so with the capital raising plan, it does plan to grow quite aggressively. So to the extent that its financing plan changes and also its investment plan is also changing accordingly, then we'll look to potentially reevaluate the rating at that time.
Kevin, come into my terminal here, if you will, when the control room's ready at GTV Go. We're taking a look at just the 2025 bonds falling below par, which was gathering some news. But I would argue at only 97 cents on the dollar, that's hardly distressed. You're looking at a yield of just above 8%. Is this company being valued correctly?
Well, with the bonds themselves, one thing to consider is that they do place a limit on the amount of secured debt that the company can issue. So to the extent that there's a refinancing, then potentially those bonds could be taken out above par. We did actually downgrade the bonds and lower their recovery rating, which assumes that there's not going to be a large recovery value.
What recovery value can you place on them?
Well, and I think with all the discussion of valuation, that's why we don't use that so much as an input into our rating process. But we do think about recovery valuation upon a reorganization. And given a company that is presently not profitable, our methodology assigns a relatively modest valuation upon recovery.
Kevin, what I liked about your smart note is you talk about the average revenue per physical member, and that has declined 6% since your original rating. Is that a macro problem, macro real estate problem, or a WeWork problem?
Well, I think it's because WeWork, I don't know if I characterize it as a problem. I think WeWork is making a decision to move into more tertiary cities and also expand its geographic locale. And so it's moving into areas outside of the New Yorks and Londons where rents are higher. So that is part of the issue. But on the flip side, costs could potentially be lower in some of these regions as well.
Kevin, talk to me about the IPO. I know that as an analyst, we were looking at maybe raising $3.5 billion from an IPO. It would secure about $6 billion from banks had the IPO been successful. Does that extra cash provide some relief, or does it concern you about how reliant they are on that cash?
Well, the interesting angle about WeWork is that when it grows, it essentially funded by the capital it raises, its credit protection metrics worsen. And so the extent it actually slows its growth, we actually see a more normalized profile. So it's not something that it's a concern. I think to the extent that the company is able to continue to move towards a path towards normalized profitability over a reasonable time frame, then that forms a basis for our rating. But we did downgrade the company to the B category to reflect that there is additional risk since the company is deciding to push that point out farther.
Wonderful. That was Kevin McNeil of Fitch Ratings. Thank you for joining me. And coming up, Ma moves aside. Longtime Alibaba chairman Jack Ma retires from the company. What's next for the Chinese internet leader? This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Tuesday marked an end of an era for Chinese internet giant Alibaba. Chairman Jack Ma stepped down as executive chairman. Under Ma's leadership, China's biggest e-commerce company had revenue of more than $56 billion in the last financial year. And Ma became China's wealthiest man with a net worth of more than $40 billion. We take a look at his story.
Jack Ma started out teaching English more than 20 years ago for just $15 a month. In 1999, he jumped on the internet train, setting up a platform for business-to-business selling. That was Alibaba. After that, he took aim at eBay with Taobao, which lets individual sellers trade with each other. 2007 was a milestone as Alibaba listed its business-facing division in Hong Kong, only to delist 5 years later as performance sagged. However, the company made a big comeback in 2014, raising $25 billion in New York with the world's biggest ever IPO.
Everybody should have a dream. What if that dream comes true?
As Jack Ma steps aside, he leaves an empire that's expanded aggressively to span retail, cloud computing, healthcare, sports, fintech, and news media, to name but a few. The challenge ahead, in the face of growing competition and a slowing Chinese economy, may be sustaining that growth. He's warned about the US-China trade war, saying the impact could last decades into the future, but also urged Chinese businesses to find opportunities from it. And Jack Ma hasn't forgotten his roots. September 10th is Teachers' Day in China.
That was Bloomberg's Rosalind Chin on Jack Ma stepping down this past Tuesday. And now to tell us more about the rise of Ma, as well as what lies ahead for Alibaba, let's bring in the man who literally wrote the book on both of them, Duncan Clark. He is the author of Alibaba, the house that Jack Ma built. He is also the chairman of BDA China. It's an advisory firm serving investors in China's technology and consumer sectors. Duncan, great to have you. What struck my mind is you were an early advisor to Alibaba. What did you see?
You know, you walked into that little apartment, as I did 20 years ago. It was tiny, but it was packed with people working around the clock. Their shoes were at the door. They were eating pot noodles around the clock. And they had this vision, this crazy vision, to become one of the largest internet companies in the world when there were just like 20 people in this room. So that was striking, but Jack Ma somehow made it believable. He has a great ability to convince investors, employees, customers, and we still see that today.
So what about Daniel Zhang, who is taking over? Does he have the same sort of figure, inspiration that Jack Ma had?
You know, I think nobody can really fill the shoes of somebody like Jack Ma or a founder of a company who's so charismatic and has built such a big business. But Daniel is a manager. You know, he has an accounting and finance background. So he has actually been sort of inheriting a machine, actually, that Jack and now I think 140,000 employees at Alibaba have built. So, and he's been instrumental himself, Daniel, in building things like Tmall and the Fresh Hippo, which is like a new kind of Amazon sort of fresh kind of approach. So we see actually he has his street cred, Daniel Zhang, but he's not trying to sort of out-charisma Jack. That's not an advisable way to do it.
Why not?
Jack is so charismatic. You can see both in Chinese and in English. He commands the room. You know, he's in any other country he'd be a senior politician at this point.
Is now not the right time? We talk about the rise of state enterprises in China, Chinese state influence. Is now not the right time to be an iconic figure? Well,
precisely, and that's why we think, you know, he telegraphed his resignation as chairman over a year ago during the heat of this speculation about, you know, how far can these figures rise in the private sector, particularly in tech, because as we know, tech around the world is coming under much more scrutiny, and in China too, and particularly when we have an authoritarian leader like Xi Jinping, you know, on the march now.
You're a former banker, so I made this one just for you. Come into my terminal here at GTV Go. We're talking, it's all about operating margin Tuesday. So we talk about how stellar Amazon's operating margins are, 4%, 5%, 6%, 7%, and then you go over to Alibaba and it's 20%, 40%. What does Baba have that maybe Amazon doesn't?
It's a very different business. I mean, people often say Alibaba is the Amazon of China, and it's really not true. It's just a shorthand that we like to use. The fundamental thing is Alibaba is a platform, literally is a platform, where other merchants can come and sell on it, or brands. But it itself is not taking inventory. It's not investing directly in the infrastructure of the delivery and logistics. So it has partners to do that, and it has the merchants effectively to offer the goods. So it's a very different business. It is, I mean, the aim of the business is to help small companies make money. It also works with big companies, but it's still committed to those third parties, to those merchants as the core of the business.
Is that where the business stays going forward?
Well, you know, it is an e-commerce company. It's 50% of China's e-commerce, which is already a third of all retail in China. So that's not going away. But Alibaba, on top of that, is building Ali Cloud, following the Amazon Web Services business. And it has big ambitions in general in R&D for quantum, for AI, of course. So it's not standing still, but it will, for the time being, be primarily an e-commerce business, but with ambitions to move into other areas.
What do you see as the biggest downside risk, the biggest black swan event that we're not looking at for Alibaba?
Well, you know, we would think the black swan would be the US-China trade war, but actually not much of the business itself is actually impacted. I mean, we can see that Amazon is having some impact from the costs that are being passed on. But actually, you know, it remains fundamentally a domestic business. So I think Alibaba's challenges will be domestic primarily. So a slowing Chinese economy, and yet so far they've been able to outgrow the economy, particularly in retail. But you know, who knows in terms of keeping the management together? You know, it's been around for 20 years. He has ambitions, Jack, for the company to last another for 80 some years, so he can span 3 centuries. That's his vision. So, how do you manage a company of 140,000 people in increasingly disparate groups? So I think internal challenges are the biggest.
As we talk so much about China trade fights, tariffs, you spend decades on the ground in China. What is their take? How do they feel?
Alibaba?
Yeah.
About the future. I think there's a lot of optimism in the company. And actually, there was a quote a couple days ago from Jack about how technology is generally viewed more positively in China.
Yeah.
And you saw the Musk-Ma kind of tie-up in Shanghai a week or so ago. And Elon Musk famously has a much more negative take on the future of singularity and so on. But it was completely different seeing the two of them side by side. They're almost inhabiting different worlds. And I think that's what we're moving to, is almost parallel universes between China-centric and US-centric tech. We have these large platform companies in the US that are very dominant here and in many parts of the West. And there's a lot of pushback. In China, there's a lot of convenience coming from tech. There's some pushback over privacy we see, but generally, most people are more positively disposed to technology because they can see the benefits in their life. We talk about cashless payment. Cash has disappeared from the streets of China. Wallets are history. It's all mobile payment or even facial payment. So, tech generally is moving faster in China, and I think that's reflected in the visions of the founders.
All things Alibaba and tech, wonderful. That was Duncan Clark of BDA China. Thank you for joining me. And sticking with China, unlike Facebook, Twitter, or YouTube, LinkedIn is one U.S. tech company that does operate on the mainland. 3 years on from being acquired by Microsoft, I spoke exclusively to the company's CEO, Jeff Weiner, about doing business in China.
It's still early days for us in China. I think the fact, if by operating in China, you mean how we've been so successful, our vision is to create economic opportunity for every member of the global workforce. And I think other companies who have a different sense of purpose or different mission or overarching objectives have probably found it difficult to do business in China because it's inconsistent with what it is that they're trying to deliver, what it is they're trying to accomplish. Whereas the creation of economic opportunity is something essentially every country in the world can get behind. And so our operation in China is still very early days. We have a talented team in place. We have greater focus there in terms of local development than we do in other markets around the world, trying to understand product market fit, trying to understand the cultural differences, and we're going to continue to invest.
With the trade and tariffs, do you feel any more pushback being a U.S. tech company over in China?
Not with regard to the nature of our business. I think for a company like Microsoft, for some of the larger technology companies, there's different implications. But by virtue of the fact that we're a professional network, the tariffs aren't impacting us to the same extent.
There's been a lot of talk that China maybe wouldn't hurt any tech company on trade or tariffs, but set up more red tape, more rules, more boundaries, more limits, and that would be perhaps maybe their way of putting more backlash on U.S. tech companies. Do you feel any of that?
I don't know that that's anything new per se. I think when you make the decision to operate in China, it's important that you're prepared to comply with the law in China in a whole host of different ways, whether that's new regulation, whether that's additional friction, whether or not it's things beyond the regulatory purview. The competitive landscape in China is incredibly intense. We continue to see that. Operating there is very different than, say, operating in the United States, and that's part of our commitment to being in business in China.
In the last few weeks, we've seen more and more probes, investigations into big tech over monopoly, data privacy. How have you managed to stay out of those headlines?
Yeah, it certainly didn't start now for us. We made a commitment roughly a decade ago in terms of putting our members first, which is arguably our most important value, codified value, maintaining the trust of our members. Without that trust, our ecosystem really doesn't exist, the business doesn't exist. And we put together some first principles with regard to how we were going to leverage data, dating back about 10 years. And those first principles were all about clarity, consistency, and control. And as a result of not just talking about that, but walking the walk and codifying that very early on in terms of how we prioritized, how we developed strategies, how we executed, where we would make changes, that has served our members very well, and that ultimately served the company very well.
That was LinkedIn CEO Jeff Weiner. Coming up, the crossroads of medicine and technology in our Wired for Health series. We'll take a look at how companies are bringing innovation to the human brain. This is Bloomberg. Following Following a break for the Apple event Tuesday, we pick up with our medical technology series called Wired for Health, where we explore how innovation does play a crucial role in sustaining health. Today, we explore brain power. Brain-computer interface company Synchron is developing a technology that will someday allow people to control prosthetics with their minds and without invasive brain surgery. The company began its first human clinical this year as it seeks to treat a range of neurological disorders ranging from paralysis to even depression. Joining me to discuss is Synchron CEO and founder Tom Oxley. Tom, for those of us who don't know, explain to me how this implant works and what it does.
Thank you, Taylor. So a brain-computer interface is a device that's implanted inside the brain that's capable of picking up signals that enable the user to control external systems. And the term brain-computer interface is as it sounds. The initial application would be for computer control use that's completely hands-free.
Do you really see this as the future of neurological diagnosis and treatment?
I think this is an industry that's emerging with the blessing of the FDA and encouragement from the FDA. It's a promise to overcome a range of problems that can affect humans all the way from their hands to muscles to nerves to the spinal cord up to the brain, that overcomes all of that by linking up the brain to a device that enables them to interact with the world once again.
Tom, you mentioned the FDA. Talk to me about discussions you have. I think we're looking forward to a worldwide trial, potentially FDA approval down the road. Any sense of a timeline or guidance on that?
For us, we've been in discussions with the FDA for a number of years. That's involved several meetings around discussion around the clinical trial, the indication, the type of patients, so that we can structure a trial that enables the FDA to give approval within a certain cohort of patients. We have entered the clinical stage, so we can't quite talk too much about that just yet. We're looking forward to doing that soon. But I can say that the FDA has been looking at this space for a number of years. BrainGate was the initial group run by Lee Hochberg that started to investigate this, and he's been a front runner with discussing around the FDA what these clinical trials should look like. So there is some history with the FDA from an investigational and academic point of view with how we should move forward, and we've really been using that history to sort of guide us forward.
Tom, what have the results from the trials shown you so far? How successful are they?
I would love to be able to talk about that. I can't discuss the particulars of the trial except to say that we have commenced the trials and the results will be coming soon. But more than that, unfortunately, today I can't announce too much.
Well, when you come back, you will. In the meantime, talk to me about some of the reaction from colleagues, peers, the rest of the medical community. What do they say about this as well? What has affected me is seeing the people who I've respected, who I've looked up to, make comment on the fact that to get to the point of a fully implantable system and demonstrating a mechanism to achieve that implant in a safe way is the next step that has now put us into the next stage of this technology development. It's a very exciting time, and it's up to this point the technology has proven that it can be extremely beneficial for patients in a number of ways, but the real challenge has been how do you get it into the brain safely in a way that's repeatable and reproducible. And Tom, how are you doing that?
So our technology does not require craniotomy, so there's no opening up of the skull or traditional open brain surgery. We use the blood vessels as the natural highway to get into the brain, and we've built a system onto a stent that enables recording of local brain activity from inside a blood vessel inside the brain.
Fascinating. Synchron CEO and founder Tom Oxley, thank you for joining me. And from technology that's literally in your mind, innovation to help what's on your mind. The mental health technology market, now estimated at more than $1 billion, it is expected to generate revenue of about $4.5 billion by 2026. That is a nearly 15% increase. We now turn to two gentlemen who are considered pioneers when it comes to harnessing technology to support mental health. That is Andy Petticom and Rich Pearson, who co-founded the app Headspace back in 2010. It has reached over 54 million members across 190 countries to date. You can access it via Amazon, Alexa, and Google Assistant. And recently, Starbucks announced its employees would be granted subscriptions to Headspace as part of its corporate wellness program. Thank you both, Andy and Rich, for joining me. So, Andy, I start with you. You two really were the leaders here. When you started this, how did you see the future? What did you see as really the future of mental health?
I think there was just a realization on both of our parts, actually, that there was a skill that essentially anybody could learn that could fundamentally change people's experience of life. And I think that it was very early in terms of science. And in terms of popular culture as well. So we knew there was the potential there. We both experienced the benefits ourselves. And I think there was a sense of combined desire to get it out there and to demystify it and make it more accessible to people.
Rich, talk to me about the partnerships. How have those helped you find people that perhaps normally wouldn't be attracted to meditation or mental health?
Yeah, partners have been a huge part of the success of Headspace. You know, ever since 2010, the very first partnership we did with the Guardian newspaper, we launched, 1 million booklets on the front of every single newspaper back in, January 2012, actually. We've worked with the NBA, we worked with Nike, and more exciting, we've been working with medical associations as well as enterprises. You mentioned the Starbucks, Starbucks deal that as of January, 300,000 Starbucks partners are going to get access to Headspace. And for us, that's like a really important milestone to, a huge company that is global in every single country around the world is now giving access to all of their partner employees is a big moment. And the AMA is another good one, another good example where with the official meditation partner for the American Medical Association. So every single doctor that is a member of AMA gets access to Headspace. So it's been a really important part of the success of the company.
And Andy, going forward, do you see more corporate partnerships the key to future growth?
I think it's one area of growth. I think we see it in sort of three parts. There's obviously the consumer, and there's B2B, and there's healthcare. I think already we're very fortunate. Most of our B2B has come. It's been inbound, and we've been servicing it, and so it's still a part of the business that we're growing at. I think the healthcare thing is what we're arguably kind of most excited about, both as Headspace and as our subsidiary Headspace Health. I think there's enormous potential to get Headspace out to people who otherwise wouldn't have access to it or who wouldn't be able to afford it.
Well, Rich, when we talk about health, I think on Tuesday when you had Apple's announcement of the watch and incorporating more of health research into wearables, do you view that as competition or the more the merrier?
No, I think it's fantastic that all of the big technology platforms are building these operating systems. Our big belief is that consumers are going to have more information and be more educated about their health, and that's going to come from the data that these powerful devices are providing. And we really want to be sitting on top of all of those devices to be able to provide the interventions and the behaviour change that people need to actually change that data. So we definitely see that all of those partners are going to be absolutely fundamental to our success for our members. Without that, we don't think that we can deliver on our vision of improving health and happiness of the world. So we're very bullish on all of those folks building all these brilliant platforms for our members.
Andy, talk to me about the investor environment. When people come to you and want to throw cash over at Headspace, do they talk about where they want the future of the company? How has the fundraising environment been?
It's been really interesting. We're incredibly kind of fortunate. And so we bootstrapped for the first 5 years, and that I really think we learned a lot through doing that. And we've been fortunate in so much as that investment has always been very sort of forthcoming. I think right now there's a recognition that this area is absolutely huge, and I think it's moved from the recognition that the consumer space, there's a huge amount of potential, to B2B and now healthcare as well. I think just within healthcare, right now, there's just not the ability to scale in the way that it needs to scale to service the amount of people who are struggling kind of with stress-related symptoms, whether they're physical or mental health-related symptoms. So I think the industry will only grow.
Yeah, wonderful. Headspace co-founders Annie Petticombe and Rich Pearson, thank you for joining me. And coming up next, California tries to force companies like Uber and Lyft to change their business models. This is Bloomberg. It could be the biggest threat yet to Uber and Lyft's business models. Their ride-hailing services have generated billions from their drivers without having to treat them as employees. Under a bill passed by California Senate, many of those independent contractors would be reclassified. That would make them eligible for minimum wage, overtime, and workers' compensation. California's lower house will take up the measure next. However, shares of both rose on the news that California's governor was still open to negotiating exemptions from the law. And another investigation for Amazon. Bloomberg has learned that the e-commerce giant is being probed by the U.S. Federal Trade Commission. The FTC is interviewing small businesses to determine whether the Amazon is using its market power to hurt competition. The news comes as state attorneys general investigating Google order it to turn over a wide range of information about its advertising business. And finally this hour, we recap our top story. Oracle CEO Mark Hurd is taking a leave of absence for health reasons. Following the initial announcement, Executive Chairman Larry Ellison said he and CEO Safra Catz will cover Mark's responsibilities during his absence. Oracle moved up its earnings report to share the Hurd news at the same time. Shares slipped in after-market trading as revenue also came up short. That does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.